One of the topics that we've written about in the note, as you may have noticed, is the exposure to that target retirement date funds have the equity exposure that they maintain depending on how many years out you are from retirement. We've written about this in the past, and we are about to embark on a much larger project, writing about retirement income and really highlighting and decomposing, if you will, target retirement date funds. So we noticed this in the data, and we wanted to go ahead and bring it to light for you to notice, so you can start thinking about it and maybe even reacting on it. And that is, we looked at the two target retirement date funds, the Blueprint Growth Strategy, and a 60/40 portfolio. And the target retirement date funds we've looked at are 2020 funds, which mean they could have been purchased at any point in time prior to today, but it's intended to be that the year of my retirement is on or around 2020. And target retirement date funds are driven by a glide path, which means the closer I get to retirement, typically the less equity exposure I take in order to preserve what I have, because I will need it and potentially need to draw on it as I enter retirement. And so for us to see here, what you see on the screen is the cumulative return during the Coronacrash. And we're trying to look at the drawdown. So from peak to trough, what did each of these asset classes do? Because if you're a retiree in 2020, your expectations are most likely that you are preserving what you have, preserving your nest egg, because if you're retiring, you will probably most likely have to draw on those funds for some or all of your income. And if you see, as you see on the screen, the Fidelity Freedom 2020 Fund and the T. Rowe Price Retirement 2020 Fund, we're not picking on these funds. They just happen to be two of the largest for this particular series. We're both down on a drawdown basis 20% in the Coronacrash. Now, the T. Rowe Price Fund was down more than the Fidelity Fund, and that's because they hold more equities than the Fidelity Fund. The Fidelity Fund holds about 45% equities, and the T. Rowe Price holds closer to 55% equities. Now, when you look at the loss here, the question is what is your expectation as the advisor, and what is the expectation of the client? Does a client expect when the year that they're retiring that they could lose 20 to 25% of their assets? Probably not. And yet what we've noticed is the equity portfolio, the equity allocation inside the target date funds, as we'll see on the next slide, has incrementally increased year over year as these funds become less reliant on bonds and get less return from bonds in their portfolio. And we think that without the knowledge of that these things could be in some degree a time bomb for investors who don't realize what's inside of them. Now, when you compare it to a 60/40 portfolio, most retirees, at least based on our experience, a 60/40 is too much vol, it's too much risk, it's too much drawdown for them. And yet one of these funds has a larger loss in the Coronacrash than the 60/40. So think to yourself, is this something that the investor is going to hold on to when they're about to retire? When you apply a risk managed process like Blueprint has, the Blueprint Growth Strategy, we came into the year at 80% equities, and yet we have a lower drawdown than the other funds who are built for retirees this year. And I just want to highlight that as having an adaptive process and the benefits of having an adaptive process. So, is a retiree expecting 60/40 risk at the trough here? Are they surprised by that? And we would estimate that they probably are to the downside. So when you look at, as I mentioned before, the equity exposure, this is a graph from the Wall Street Journal that basically compares the 2005 glide path to the 2019 glide path. And all this is showing is that the portfolios in 2005, when you look apples to apples, you're looking at the same years before retirement or after retirement, and you look at that in 2005 and 2019, the 2005 version of that fund is holding substantially less equities than the 2019 version. So the glide paths change, and not a lot of people, not a lot of investors, certainly not a lot of advisors understand the magnitude of that these glide paths, the changes in these glide paths can have. So we're bringing that to light, and we're really going to do a deeper dive on this to illuminate this for you. And hopefully what we intend to do is show you that there's a better way. So we highlighted this. This is at the year of retirement. So this gap between gray and blue is really what these 2020 funds are experiencing this year. It's a substantially higher allocation to equities, and therefore, in a Corona crash environment or a bear market environment, the drawdown and the maximum loss is going to be worse.